Hello, this is Quanra Invest. Today I'll be talking about the Max 7 stocks as well as which ones to buy and which ones to avoid. So the first company over here is Tesla. Tesla is currently a company that is trading at 120 times earnings, and today is down around 6% because of the Mark Rober video or German report whereby not too many Germans are buying Tesla cars now, and then they had a delivery miss as well. So for me, Tesla is simple. Tesla is an avoid. I don't think it should be sold right now. If you're holding on to the stock, then obviously don't sell it because maybe I'm price anchoring, but this stock is down around 50% year to date already, and it is likely that Tesla will see a bounce soon, especially when Elon Musk gets less political and all that, because this company has a lot of tailwind behind of it with your Robotaxi, your Optimus, and all the different stories that are coming up. So for me, I don't like buying into companies with no fundamentals. So this company over here is growing 1% year on year. For me, I don't like this, and it's diluting shareholders. Net income growth is down, and most of this net income over here was because of the Bitcoin sale, which I don't like. So this company over here, it has most of its revenues coming from automobiles, meaning to say it is still a car company. And historically, if you look at other car companies, it's 5 PE. So for Tesla over here, it is currently trading at a valuation that is absurd. For me, I would avoid it, but if you're trading, it could be a possibility for you to get in soon as the fundamentals align. So next stock, Nvidia. So Nvidia for me is a company that I find too hard to understand. I don't know what their moat is. It is the only company in the Max 7 that has no touch with the consumer. So if you were to look at all your different other Max 7 companies, they have some form of touch with a consumer, which leads to more scale and normally leads to more durable business. But for Nvidia over here, it is the only company in the Max 7 that has no touch with consumers, meaning to say the only touch that they have with the consumer is under the gaming category, and that portion is actually declining. And this company over here is a company trading at a $3 trillion valuation over here, and it's trading at 40 times earnings, 26 times forward earnings. So for me, Nvidia, it's an avoid as well. The only time I will consider Nvidia is maybe if it drops another 25% from here. But with such explosive growth, I don't think they can continue this on and on and on. And especially with the capex spend going up on this uptrend now, as soon as it turns, Nvidia's stock price will drop because the fundamentals will get hit and the growth won't be as explosive as before. So for me, Nvidia is an avoid. I don't know about you, but I don't understand the business. I don't understand the mode of the business enough yet. And I think the most predictable way for you to participate in this AI revolution is for you to invest in another company called ASML. And so Nvidia for me, it's an avoid. Although ASML is dependent on Nvidia as well, I don't think Nvidia is as predictable as ASML. Next company is Meta. So Meta has been hit quite hard recently as well. From all-time highs, I believe it's down around 20% from all-time highs. Correct. So it surged up to around $740. It went on this 20 days winning streak when it just went up and up and up every single day after earnings. And then as soon as it hit $740, it just went down. So year to date, it is up 2%. Compared to all the other Max 7 stocks, it's actually doing quite well. And this company over here is currently trading at a 25 times earnings, a 23 forward earnings. So if you have to look at Meta's historical PE ratio, it is currently trading at a decent valuation compared to its past. The only exclusion being in 2022 when the stock basically went all the way down to 9 PE. I don't know why no one bought into it. I was quite young back then. I bought some shares of it. But anyways, so for Meta over here, it is a company growing revenue at 20%. I do believe that we will see some form of slowing down in the future, but they still have many other different departments that they can monetize. So you have WhatsApp, Instagram Reels, you have your new Threads app and all that. And so I think Meta, even though it is already a company that has so much people using it already, somehow they can still find people to continue using the app, which I find incredible. So this company over here is growing 59% revenue, 59% net income growth, and I do believe that Meta currently is a consideration for me. I would love to own this company. In fact, I would love to own it if it goes down even more. And for me, Meta is a decent stock now if you're looking at a company to hold for the next 5-10 years. Because I don't see anyone displacing YouTube, not YouTube, Facebook, WhatsApp, Instagram, and all that as well. So next company, Google. So Google is simple. Google is a strong buy now. Google is currently trading like it's dying. The business is currently trading at 20 times of earnings. That's just crazy. The past month alone, it is down around 10%. Year to date, down 12%. From all-time highs, down around 20% as well. So Google is a company that is growing revenue at 13%, growing net income at around 35%. And this company is currently trading at a 20 times of earnings. Incredible. Okay, anyways. So assuming Google continues growing at around 15%, that is still a 1 point something peg for this company. And it is currently trading at one of its lowest valuation points in the past 5 years. That's just incredible for a monopolistic business like Google. And yes, there are arguments to be made about how LLMs can displace Google, but are you really using the LLMs to go and search for your restaurants, to go and find travel, to go and find where the next destination is? I don't think you're doing that, correct? And Google has an underrated portion of their business as well, which is YouTube. It has no innovation risk. Every day creators are just creating YouTube videos like the one that you're watching right now. And yeah, it's just infinite money for YouTube and infinite money for Google. So I think those YouTube and Google Cloud platforms are two very underrated businesses, and I don't think Google is I don't think it's justified for Google to trade at 20 times of earnings when you have Amazon at 35 times, you have Microsoft at 30 times, you have Meta at 25 times. So for me, Google is an extremely strong buy. I think this stock is at least 15 to 20% undervalued. So if you're buying today, you're getting a pretty large margin of safety. Next one, Microsoft. Microsoft for me is hovering between consider and a strong buy. In fact, I bought a bit of Microsoft back then at around $385. I bought it at around 400. That was my first tranche. Second tranche was around $380 or so. So for Microsoft over here, it is a company that is extremely predictable. It grew revenues and earnings even during the bad times in the past few years. So as you can see over here, 2022 we had a stock market crash. Microsoft still grew earnings during that time, and in 2020 as well, when we had the COVID crash, Microsoft grew earnings and revenue as well. So I think for Microsoft, it is a company that is extremely predictable. It's a buy and hold business forever. And if you were to look at just the valuation from the past, it is currently trading at one of its lower ends of its valuation. So the lowest end they got to was around 26 times. So for me, I think Microsoft is decent for today. And if you were to just do a simple EPS calculation over here, assuming they hold their they grow their EPS by around 14% over the next few years, and their EPS now is around a 12.42, assuming they go to the lowest possible valuation of around 26 times over the past 5 years. Microsoft today is yielding around a 10 to 11% return, which means it's around 10% undervalued. So for me, Microsoft is decent. It's a strong consideration now. Hopefully the stock gets a lot lower so that I can buy a lot more of it. Next one, Apple. So Apple is an extremely loved company in this stock market. I can't believe how Apple is trading at 33 times of earnings even after the dip of around 13% in the past month. So if you look at just the fundamentals of Apple, it's not growing at all. Its revenue is growing at 2%, 7%. Net income growing at around I believe it's negative. So this company is a company that is lacking innovation. It has high valuation risk, and Warren Buffett has been selling out of it almost. He halved this position from a few months back. So for me, Apple, it's simple. Apple's a sell. It's a high quality business. Don't get me wrong. People won't stop buying iPhones. No one's gonna stop buying their iPhones and their iPods and all that. In fact, the thing that you're looking at right now is an iPhone. The thing that's on my screen right now is a MacBook. And so no one's gonna stop buying it, but they lack innovation, they lack growth, they have no more growth paths other than the Apple AI, the Apple Intelligence thing, which I think it's a bit far-fetched. So for me, Apple is a sell. Next one is Amazon. So Amazon over here is currently trading at a 35 times earnings, 34 earnings. For me, it's simple. Amazon is a buy. I do believe that Amazon is one of the highest quality businesses in this list over here. So in terms of business quality, I think Microsoft is up there with Amazon, followed by Apple as well. And then it'll be Google, Meta, Nvidia, and then Tesla all the way down there. So in fact, I think Nvidia and Tesla are all the way down there. So it's Nvidia, Tesla, Google, Meta, Apple, followed by Microsoft and Amazon. So Amazon has one of the most durable businesses out there. It holds around 40% of the US online market share in terms of the retail market. And for Amazon over here, the story is extremely simple. So it's just a story of margin expansion. So if you have to look over here in 2023, Amazon's margins of everything outside of AWS was around 2.7%, and in 2024 it went up to around 5.4%, I believe. So it's somewhere here. It grew to around 5.4% in 2024. I do expect them to continue improving their margins, and if they can grow to around a 7% margin, then that's around a $210 stock already, easily. And that is assuming a multiple contraction as well. It is currently trading at a 35 times earnings. Assuming it contracts all the way to 30, that is already around a $210 stock already. So for Amazon over here, I found all of these things online. So their margins are crap on almost every single metric over here. So you have subscription services growing at 10% operating margin. You have third-party seller services around 10% as well. So I think it's easy. It's extremely easy for Amazon to start improving their margins for all these different businesses over here. So for example, advertising should be a 35% operating margin business. You have Meta at 35%, you have Google at around 40%. So there's no reason why Amazon should have a 10% in terms of their advertising. So if you were to bump the advertising to around a 35%, if you were to bump their subscription to around a 20%, which is extremely doable as well, that is already a $221 stock for Amazon already, assuming all this valuation metrics over here. So for me, Amazon is a strong buy. I think it is one of the highest quality businesses in the entire Max 7. And yeah, I've been buying into it. Hopefully it dips more so that I can get a full position. Hopefully it gets to around $140. That will be my extreme buy price. I will just load the boat on Amazon and just hold it long term.